afternoon, everybody. Welcome to today's edition of the Boutique Manager Showcase Series, presented by BX Capital. Today's edition features Charles Helmy, the portfolio manager for a number of BX Capital portfolios, most specifically the large cap growth portfolio, which we are going to focus on today. Just as a quick reminder of what BX Capital, the firm that we represent, hosting the call, does, amongst a number of other things. We work with we do due diligence on hundreds of boutique money managers out there, kind of doing a lot of the legwork for you. And we find a select few that we think are really noteworthy and worthy of significantly more attention. Then we work with them to make them available on more platforms more easily to you, and then work to get out the word about them to you. One of those platforms that these managers are now going to be available on is our very own customized asset management platform. Really sleek technology. If you haven't seen it yet, there's a number of really good managers available to you there. You can get a hold of us and we'll sign you up for a demonstration. Love to get that in front of you. But without further ado, what we're here to talk about today is the BH Large Cap Growth Strategy. So with me is Charles Helmy, the portfolio manager there, and Arun Kaul, the CIO of BX Capital. Arun is really responsible for spearheading all the due diligence efforts amongst all the other investment management research functions here at BX. Wanted to bring Charles on today. I'm a simple guy. I think that the numbers are extremely noteworthy. Just looking at the portfolio over a 10-year period, more than 750 basis points better than the S&P on a gross basis. Really impressed me because it wasn't a one-hit wonder. This is consistent rolling out performance, which I think is noteworthy. Just as an idea of what that can do for you, $100,000 10 years ago in Charles's strategy would return you over 700 today. Whereas the S&P 500 has had a fantastic decade, you'd be left with just over $300,000. So really compelling returns. So with that, I wanted to get Arun on to kind of have a conversation with Charles about how they run the portfolio, what they see going on in the markets, and what the advantages of this strategy right now might be. So with that, Arun?
Great. Thank you, Chris. Thanks so much, and welcome everybody. And thank you, Charles, for joining us today. I thought we could start out, we'll take about, 30 minutes today and go over your strategy. So we can start out with maybe touching on your philosophy and your methodology. Then we can move on to talking about the market environment, some of the stocks you're looking at, specifically what you think about some of the valuations in terms of growth and growth versus value. Maybe touch on some macros as well and get some of your fearless forecasts from you looking forward. But maybe just to start, we can give a little bit of background just on the philosophy of the strategy for the growth strategy and just how that ties into some of your methodology.
Well, thanks very much for inviting me to present. The philosophy is pretty straightforward, easy to understand. We invest in high quality, sustainable growth companies with superior managements and compound their growth at high rates. So they're real businesses that are established. Their companies are high quality, meaning they have growing free cash flow. So things we don't do is we don't buy IPOs. We rarely purchase companies that depend on markets for financing. And that means we don't own the top stocks like Virgin Atlantic. We didn't buy Amazon or Netflix. And we don't own the one-trick biotech stocks that have been the screaming winners in this market. Why not? Well, for each high-risk 10-bagger that you might find among the thousands of companies out there, there tend to go to zero. So we don't buy moonshots. We also try to avoid untried managements, and we want to avoid them because anyone who's willing to take a flyer on a company that may not be around in 5 years, I don't want to trust with my clients' money. So that's important, and only because we take concentrated positions. So we typically hold just 20 stocks, and closet index. Anyone can closet index and make out, 1 year or another and be generally successful at gathering assets, but we're trying to do better for our clients. So we try to eliminate all the best opportunities, and those are mostly either undervalued or misunderstood companies that may have recently fallen out of favor or forgotten, but are about to revive. And that could have been Apple 2 years ago, or it could have been Microsoft a couple of years ago. Both of those companies were out of favor and left for dead, but we doubled up on them in the end of 18. So we like companies with great businesses that may be getting rid of a low margin or an inferior business, or maybe they're going temporarily through a soft patch on a major product launch and investing a lot. But the result of that is going to be a permanent change for the better.
All right. And can you maybe just touch on some specifics? You mentioned free cash flow. You mentioned, I guess, potentially turnarounds or rising margins. Is there a pressure that you see is more important in terms of returns on invested capital, free cash flow, dominant position, anyone that you rank higher than the other, or what else other key parameters that you look at?
If you run a back test on any strategy, you can see that high ROE wins out by far as the strongest criteria, and that's our primary criteria for investment. So you have to have a high return on capital, high return on equity, and recently our emphasis on the high revenue growth rate has been a major winner.
All right.
On the other hand, dominant or disrupting the market position relative to competition has also been a market leader.
Right. And are you looking for those type of firms with higher revenue growth to also have the higher ROE, and for the instructors to also have the higher ROE, or will you sometimes make a trade-off in that area?
We rarely subordinate the ROE to the revenue growth rate because these companies are established. It's usually a sustainable or long-term superior ROE. It's not just the trailing 12. So you may find companies, like Zoom, that after flatlining for a decade, they all of a sudden just take off and they've got 100% revenue growth rates. But that's going to be a different company in a year from now than it was a year ago, and it remains to be seen whether management can manage through that kind of explosive growth.
Sure. No, fair enough. And I guess you mentioned real business is the compound over time, and you avoid IPOs. Is there a general time frame when you would start to enter a stock in terms of after its IPO, or in terms of creating a real business content, or is it profit? Is it ROE? Is there a time frame specifically? How do you sort of look at that demarcation, especially today we've got so many of these higher growth names that are shorter track records, but obviously have a lot of high top line and high top revenue growth.
So we like to see sustainable growth through a business cycle or through a market cycle. That means that most of these companies have access to the investment grade debt markets, and many of them have investment grade ratings. So what happens is if companies get over their skis in a very rapid growth environment and they lose it, then they try to go to the market and they can't actually raise money. They've got to go to the convertible bond market, do a big dilutive offering, and that hurts investor value beyond the fact that the stock has cratered.
Right.